All right, let's get into it. In this explainer, we're going to pull back the curtain on the U.S. tax and immigration systems. We're not just scratching the surface here. We're going to dig deep into the core principles, the clever strategies, and yeah, the very real risks that really define how these massive systems actually work. Okay, so here's our game plan. We've got 4 key areas to cover. We're going to start with the absolute basics, the foundational principles everything else is built on. Then we'll get into the strategic levers you can actually use. After that, we'll navigate some of the most critical pathways. And finally, we'll look at what happens when things go wrong, the major pitfalls, and the serious consequences. First up, the foundational principles. You see, to really get a handle on these systems, you have to know the core rules of engagement. Think of them like the laws of physics. They govern every single thing that happens from here on out. So, at the most fundamental level, the U.S. tax system is really split into 2 separate universes. We've got business taxes on one side and personal taxes on the other. It is absolutely crucial to see them as 2 different worlds, each with its own rulebook, its own obligations. Getting this part right is the key to everything else we're going to talk about. But, and this is a huge but, there's a special mechanism that basically collapses those 2 worlds into one. It's called the pass-through entity, and this is a total game changer. With this setup, the business itself doesn't pay any income tax. Instead, all the profits or losses flow directly or pass through to the owner's personal tax return. Now watch this. Let's switch gears to immigration for a second, because we see a very similar kind of financial thinking pop up in a completely different area. The public charge doctrine is a perfect example. On the surface, it sounds like it's about not being a burden, but really, at its core, it's a financial tool, a way for the government to try and predict if someone might become a financial risk down the line. And this just illustrates that underlying principle perfectly. The government's concern here isn't about a public health risk, like spreading a disease. No, it's about the potential long-term financial liability that a person's chronic condition might represent to the taxpayer. It's an economic calculation, not a medical one. Okay, let's move on. Now that we've got the basic principles down, let's see how you can actually use that knowledge to pull some pretty powerful strategic levers, especially inside the tax system. So the absolute heart of so many of these advanced tax strategies is a concept called depreciation. It's really just an accounting tool that lets you deduct an asset's value over a certain amount of time. And the keywords there are on paper. And here's the magic trick. This mechanism can generate what experts call a paper loss. And this is an incredibly powerful tool, because while your actual real-world asset might be going up in value, on your tax documents, it looks like you're losing money. A loss that you can then use to cancel out real income. Now, to really crank this thing up to 11, there's a specific process. You do something called a cost segregation study, where you basically break a property down into all its little pieces. This lets you write off things like carpet and light fixtures way faster than the building itself, which means you get to cram those huge paper losses into the first few years you own the property. And this is where the strategy gets really, really powerful, especially with short-term rentals. There's a special little provision in the tax code, kind of a loophole, that says if you meet certain criteria for actively managing the property, these paper losses can be used to offset not just other investment income, but your actual W-2 salary. I mean, this is how some very high earners can legally drive their tax bill way down, sometimes even to zero. All right, let's turn back to immigration. Now here, the pathways aren't so much about financial levers. Instead, they are all about navigating these really critical, often subtle distinctions and dealing with a surprising amount of human discretion. For example, and a lot of people don't know this, you don't actually apply for automatic citizenship. You apply for a certificate to prove you already have it, and it can only happen through one of 2 totally separate legal paths. You either acquired it at the moment of your birth, or you derived it sometime after you were born. And the rules for these two paths are fundamentally different. They're non-negotiable. For acquired citizenship, everything depends on the parent's history before the child was even born. For derived citizenship, it all comes down to the child's legal status at the exact moment their parent becomes a citizen. You get this wrong, and the entire claim just fails. End of story. And this leads us to one of the most critical and honestly most frustrating parts of the system: discretion. You can do everything right, check every single box, provide every document they ask for, but at the end of the day, an officer can still deny the case based on a final, subjective merits determination. It's a total wild card that can derail an otherwise perfect application. So, we've seen the strategies, we've seen the pathways, but what happens when it all goes wrong? When the rules get broken or just misunderstood? Well, that leads us to our final, and you could argue most important section: the very real consequences of making a mistake in these high-stakes systems. Understanding the pitfalls is every bit as important as knowing the strategies. The consequences here aren't just a slap on the wrist. They can be absolutely irreversible. In the tax world, if you fail to pay, what kicks off is a very clear, methodical, and incredibly powerful process. It's not random. It's a sequence of events that starts with a notice and ends with a federal tax lien on everything you own. That lien gives the government the legal right to simply seize and sell your assets, your house, car, bank accounts, to get their money. And in immigration, just submitting a document has its own massive risks. This quote from the source material, you can almost feel the panic as the person realizes the gravity of what they just did. And here's the crucial point. The issue isn't just about telling a lie. The act of submitting a document that implies something that isn't true, like handing over a tax return as if it was filed with the IRS when you know it wasn't, that itself can be seen as fraud. The document itself is the misrepresentation, and that can have very, very severe consequences. And look, it's not always about some big dramatic act of fraud. Even simple procedural errors can completely derail you. Using the wrong income line from a tax form, filing from someone else's online account, submitting a form when you're on a tax extension, these might seem like small mistakes, but they are system stoppers. They trigger delays, requests for more evidence, and can even put the entire application in jeopardy. And all of this leaves us with one final big question. In systems this complex, where the line between a strategic advantage and a severe penalty is razor thin, what's the right way to approach it all? It suggests that maybe the most critical skill isn't finding loopholes, but instead mastering the rules with absolute precision and a deep respect for the consequences.